Welcome to Alpha Insights. I'm Hope. Today we're breaking down what's been happening with United Health Group and why investors are watching Medicare developments and a mid-April earnings report. Joining me is Jonathan, market analyst. Jonathan, great to have you. And remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks for having me, Hope. Glad to be here.
Walk us through the business first. What exactly does United Health Group do that's made it such a market leader?
Sure. United Health Group is really two big businesses in one. There's United Healthcare, the insurance arm that sells employer plans, individual coverage, Medicaid, and Medicare Advantage. Then there's Optum, which is health services. Think clinical care, pharmacy services, and analytics. The combination is powerful because insurance drives scale, and Optum provides higher growth services and data that the insurer can use. I mean, when you look at the data, that mix is why the company sits as a roughly $256 billion company, and why people still see long-term optionality. But the big story right now is Medicare Advantage. Regulators and researchers flagged what they estimate were sizable overpayments to private plans, and that kicked off intense policy scrutiny. One report put the overpayment around $13.4 billion. That raised questions about reimbursement going forward, and pushed management to be more conservative in its guidance.
So, the real question here is, how big a hit could that be to revenue and earnings? And what should listeners expect heading into the company's quarterly update?
Short answer, meaningful but uncertain. Management has already signaled this could be the first year in a long time with material revenue pressure, driven by lower Medicare Advantage risk adjustment and payment changes. At the same time, United Health still generates a lot of cash and has that Optum engine to offset some of the pressure. Analysts note the company trimmed guidance to reflect these reimbursement dynamics, rather than surprise the market later. So the market is trying to decide if this is a temporary pullback or a multi-year reset.
Right.
On valuation, the stock is trading well below last year's highs. The latest market price sits around $282.09 versus a year high north of $600. Trailing earnings per share were about $13.19, producing a trailing price to earnings near 21. Forward price to earnings is lower, closer to 16, and analysts' consensus targets range widely. The mean sits in the mid-300s. Some see upside if Medicare headwinds ease, others are more cautious. The research here suggests a fair value midpoint around $365 per share, with a reasonable range of about $320 to $420, depending on how fast Medicare trends normalize and how Optum performs.
Honestly, I was a bit surprised by this one.
Yeah, that's a good point. The puzzle is that the company still throws off steady cash and a dividend yield that's roughly 3%, which cushions downside for some investors. But the regulatory risk is real. If CMS or lawmakers push for clawbacks or more conservative payments, that could compress earnings for multiple quarters.
Got it. So what are the concrete risks and the things to watch next, especially for listeners who own shares or follow the stock?
There are a few clear items to watch. First, any updates from CMS or congressional commentary on Medicare Advantage methodology. That will move the needle. Second, the company's mid-April quarterly report and guidance update. Investors will look for Optum growth trends and commentary on cost control, fraud, and abuse programs. Third, enrollment and risk adjustment data that show whether prior overpayments reverse or are adjusted slowly. And on the market side, technical levels matter too. Short-term support around 260 and resistance in the low 300s. For different investor profiles, the considerations change. Long-term investors may monitor CMS updates and consider dollar cost averaging if they believe the headwinds are temporary. Short-term traders will likely trade around the mid-April print and use defined stops because volatility is higher right now. Importantly, analysts remain skewed toward buy ratings overall, but there's a split. Some firms are waiting for clearer policy clarity before getting more bullish.
Interesting.
One more point on risk. Optum is the growth offset, but it can be lumpy. If Optum slows or runs into execution issues, that removes a key buffer against insurance margin pressure. Macro factors like employer enrollment trends and investment returns on reserves also play through the numbers.
Good to know.
To be clear, and this is important, I'm not giving buy or sell advice. Analysts note the franchise is high quality, the dividend and cash flow are supportive, but regulatory uncertainty creates near-term earnings risk. Investors should size exposure to match their risk tolerance and follow the CMS story and the mid-April earnings update closely.
Okay, let's wrap with the main takeaways.
Sure. First, United Health is a diversified health leader with a big services arm that can offset some insurance pressure. Second, Medicare Advantage reimbursement scrutiny is the central near-term risk and could meaningfully affect revenue this year. Third, watch mid-April earnings and any CMS commentary for clarity on the trajectory.
Those are helpful. If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks, Jonathan.
Thanks, Hope. Always good to break these down.